Of course, in confusing times, it's easy to make mistakes. The question becomes, are you making one now with your retirement plan? Hi everyone, I'm David Scranton, and thanks so much for joining me here on The Income Generation. You know, I don't need to tell you that we live in difficult times. Sure, the economy's recovering, but there still are major challenges ahead. And frankly, in all that confusion, it can be harder than ever before to make good decisions and easier than ever before to make mistakes. So today, we'll be talking about 4 mistakes that you might just be making right now with your retirement dollars. And we're also going to cover, of course, how to fix them. So what are they? The risk of ignoring your risk tolerance level, having the wrong stock market strategy, having the wrong bond strategy, and last but certainly not least, having the wrong retirement income timetable. And of course, helping me out as usual is income specialist and best-selling author Jeff Small. We'll also hear from our special guest, author and editor Harry Dent, a repeat guest, of course, for the Income Generation, as well as income specialist Tim Sparks from Kentucky and Brad Williams in Alabama. And as always, we'll answer your retirement questions. But first, let's begin by talking about why it's so important to know and to understand your own personal risk tolerance. Recently, we did an entire show devoted to this topic. And that's how important I feel it is at this specific time. Because as we explained in that show, risk tolerance is an assessment of how much risk you can handle. Now, some people are wired emotionally to handle a lot. Others can take very, very little. And as far as investing goes, risk tolerance actually relates to your ability to handle these losses. So if you're investing for growth in the stock market, the question becomes, how much market shrinkage can you actually tolerate before you panic? Now, your natural attitude toward risk is one factor, but it's only one factor in determining your overall investment risk tolerance. So what are some of the other factors? Well, your age, which really becomes more of your stage of life, your retirement timeline, the amount of cumulative investment assets you have, and of course, your individual retirement goals. So why is ignoring risk tolerance one of the biggest mistakes you could be making right now? Well, one reason is that, yes, these are uncertain and deceptive times. Of course, yeah, the recovery from COVID-19 is going pretty well, and the stock market has hit several new record highs. However, behind that bright picture is really a lot of huge unknowns. Inflation, interest rates, debt, and when I mean debt, I mean primarily national debt, the prospect of corporate tax hikes. Those are just a few of the issues that could quickly undercut this recovery and undercut investor confidence. So the point is, you may be carrying more risk than you realize, meaning more risk than is right for your retirement plan with all these issues factored in. For example, maybe your mental risk tolerance is quite high. So you're fine with your current allocation on an emotional basis. But have you considered how a big financial loss right now might affect your timeline for retirement or your goals? Would you have to adjust your goals or delay your retirement if you had a big loss? So assessing your risk tolerance is really an important key to having a financial strategy that's right for your stage of life, right for your goals, right for your timeline, frankly, more now than ever before. So before I welcome Jeff, let me take a moment to answer one of your questions. Cynthia from New Mexico asks, my husband is much more of a risk taker than I am, and we argue about that at times. What's the best way to make financial decisions we're both comfortable with? Well, I get that question a lot, and frankly, everybody knows who's been married for more than a decade or two, and hopefully less than that, knows that marriage and all relationships are about compromise. It's about making sure that you meet that middle ground. So the same is true here. It's important to have those risk tolerance conversations. And that person who's more aggressive in the relationship might have to pull it back and get a little bit more conservative And the person who's conservative might need to find ways to get comfortable getting just a tiny bit more aggressive. Now, sometimes it's hard to do. There's a reason people go to marriage counselors sometimes when they have issues between, two members of the couple. Well, that's where a good income specialist, Cynthia, can really get in there and be that retirement planning counselor, if you will, perhaps for both you and your spouse. So Cynthia, great question, and thanks so much for submitting. I appreciate it. And be sure to send me your retirement questions by emailing me at askdave@theretirementincomeStore.com. Now, let's bring in Jeff Small. And some of we actually record this show. We don't come in the studio Sunday morning. We record it a couple days before. And Jeff, I'm actually excited because we always talk about your fishing trips, and I live vicariously through you. But I'm kind of fired up because we're going fishing together this weekend, which will actually be kind of fun.
So Dave, I'm glad we're going fishing this weekend. I think we're going to load up the boat. But you gave away our trade secret when you tell the audience that we record on the weekdays, but we have to do that because we have national guests. But on today's topic, Dave, as far as risk tolerance goes, I'll tell you, most investors don't understand what their own risk tolerance is until the market falls. And we've seen that time and time again in very uncertain times. So what's happening today is investors are saying, you know what? The market's kind of elevated. My radar's going off. What do you think, Dave?
Yeah, and it's, of course, as you know, that human nature is that when the markets are going up, people think they're more risk tolerant than they really are because they haven't seen a loss in a while. When the markets are going down, oftentimes they find out they're more risk averse. So some people got weeded out and found out they're risk averse, I should say, in March of 2020. But because the Fed stepped in and the markets recovered so quickly, I think a lot of people weren't weeded out, and maybe they didn't even get a chance to see that one or two statement that was down by 30+%. So it is scary right now because there are a lot of people who you think they're more risk tolerant than they really are, and I'm afraid that when the other shoe drops, they'll find out the hard way.
History is a great teacher, but it becomes a problem when folks don't listen to it. So if you've got money in the market, pay close attention to these new all-time market peaks. It's time to not let your guard down, but have your guard up.
Yeah. And of course, the reality of it is, if you're investing for income, even in the stock market, and the stock market takes a big drop, well, now it's easier to handle because you're getting the dividends that you need now or in the next few years for retirement. So it doesn't have to affect your lifestyle. It's only going to affect you with that emotional factor we talked about. But if you're not investing for income, be it and in the stock market just for growth, then it's going to affect your actual retirement, not just the emotions, but your actual goal. So Jeff, thanks. And of course, coming up, we're going to welcome today's special guest, author Harry Dent. But first, I'll talk about the second retirement planning mistake that you just might be making, and that is having the wrong stock strategy. All that and more coming up here on the Income Generation.
Are you truly ready to retire? Do you have the right strategy to pay for your lifestyle for the next 30 years or more? Take our free retirement readiness quiz at areyoureadyforretirement.com and discover what your retirement strategy may be missing. Don't let market volatility derail your retirement plan. Make sure you're fully prepared by learning about hidden risks to your retirement. Visit areyoureadyforretirement.com and take our free retirement readiness quiz.
Welcome back to the Income Generation. I'm David Scranton, and today we're looking at 4 mistakes that you might just be making right now with your retirement plan. So far, we've talked about the importance of not ignoring risk tolerance. So now, join me as we talk about a mistake that you might just be making with your stock market-based strategy. And this applies whether you're in individual stocks or stock mutual funds. Okay? Now, obviously, there's no cookie-cutter financial strategy that's right for everyone. But the fact is, most of us use a similar basic strategy for investing in the stock market throughout our entire working life. And typically, that strategy is to grow your savings, but doing it by investing for capital gains, as I said, in things like stocks or stock mutual funds. Now, this is usually a growth-based strategy, and for many people, it can make sense when you're in your 30s or in your 40s, because at that point, you're still in the growth and accumulation stage of life. Retirement's a long way off, and if your market growth turns to shrinkage, you still have time to recover your losses. But as we often point out, once you're over the age of 50, you're now transitioning from the growth stage to the income stage. And suddenly, retirement simply isn't that far off anymore, because you'll soon need your assets to generate income. So, does that mean you should automatically get out of the stock market? Well, no, not necessarily. But it does mean that you should revisit your stock strategy to make sure it's still the one that's right for you. And since you're transitioning to the income stage, now might be the right time to shift from a growth-oriented strategy to a value-oriented stock strategy geared toward dividends. Because in my experience, the right value-oriented dividend-based stock strategy can help you lower your stock market risk and give you a more practical way, a more income-based way to invest in the market as retirement actually approaches. In addition to that, these dividend-paying strategies, like all income strategies, are kind of a bird-in-the-hand approach because it allows you to keep growing your portfolio organically. A strategy that might work especially well in today's market, as Jeff and I will discuss in just a minute. But now it's time to take one of your questions from Corey in Florida. What do you think is really a good approach when you're talking about dividend-based stocks? So Jeff, let's talk about this. I'm going to push this off to you a little bit. What would you tell Corey a little bit about dividend-based, value-oriented investing as it differs from growth?
Well, Dave, I would tell Corey that they should have a combination of stocks right now with an emphasis in value. Value keeps your portfolio more buoyant when the market becomes more volatile. And so there's going to be some trading days here in the next month or two where you're going to see value stocks drop and growth stocks go up and vice versa. And those are the days they should be dipping their toes into value stocks, Dave.
Yeah, I agree. It's so the value, which most people don't understand, is value is more conservative. If you do it right with dividends, it could give you more income now, which is great. But it's also, for reasons we mentioned on a show just a couple weeks ago, it's a more difficult way to invest in the stock market, which is contrary to what a lot of people think. So Corey, thanks so much for your question. And if you have a question, just email me right here at askdave@theretirementincomeStore.com. And now let's welcome our special guest, Harry Dent, author of 0 Hour and editor of Economy and Markets newsletter, which is available for free at harrydent.com. Harry, thanks so much for being back with us right here on The Income Generation.
Yeah, nice to be back.
Harry, it's great to see you again. You are one of my favorite guests to have on our show, and we interview a lot of really big national iconic people in the financial space. But you and I and Dave both know that volatility is the greatest risk to folks that are over 60 today. So what should folks do at these new record all-time stock market peaks at this stage of the market cycle?
Well, in short, get defensive. We have seen the greatest short-term run volatility to the upside ever in history in the stock market since the COVID crisis hit and stocks crashed into March 2020. So that upside move means the next move is going to be very sharply, in fact, probably the sharpest we've seen in history. And very likely over the next few months is when this could happen. So you have to get defensive as quick as you can here. This is not something most people are going to see coming.
So define defensive, Harry. So when we say defensive, does that mean liquidating and getting out and going into cash? Or does that mean buying value stocks, which might be more buoyant if the market becomes turbulent?
No, this is an everything bubble. Everything crashes. Real estate, value stocks, growth stocks. Any bonds that are not treasury bonds or AAA. It's a reset of all financial assets after the greatest financial asset bubble in history. And again, it includes real estate. So you get out of risky assets into the safest. So people say, oh, gold. No, gold has bubbled up just like stocks in recent decades. It is in the commodity complex, which is very volatile and has another big downturn to come. Gold will hold up better than most commodities, but the best safe haven is good old long-term Treasury bonds of the US of A. Everybody says the dollar's going to crash. I'm sorry. I'm looking at 2008, which was a preview for this crisis deeper, and the US dollar went up, and the US Treasury bonds were the best safe haven. And you know what? The longer, the better. 30-year Treasury bonds is what I'd be buying now, and I'd be getting out of stocks and real estate and higher risk bonds.
Or high quality corporates. I would assume high quality corporates are okay too if you're picking the right companies.
Quality in triple A. There aren't many of those, by the way, these days. So yes, but anything with risk on it. So bonds like the falling interest rates and inflation and deflation, but they don't like the rising default risk. So that's why you're right. Only the highest quality, triple A, AA, and then the 10 and 30-year treasuries, that's the place to be. Anything below that's going to see more default risk rising than benefit from the deflationary aspect.
So Harry, is this avoidable at all? I mean, can the Federal Reserve do something to stop this from happening eventually? I mean, they seem to be trying.
Yeah. Can the fox save the hen house? No. They created this bubble. The bubbles into 2007 were natural in that cycle. I call it the fall bubble boom season, like the roaring 20s. And yes, they got bubbly, but this is entirely on central banks around the world and the Fed. They did not allow the economy to deleverage and get rid of a lot of unproductive debt and zombie companies. We have 20% in rising zombie public companies. Forget small businesses failing at higher rates. So they didn't let the economy deleverage. So we're going to have a bigger downturn this time. They are the problem. Therefore, there's no way they're going to be the solution. If they just taper like they did, remember late 2018 where they just tapered a little bit? The repo crisis came right away, and they had to start printing money again faster than ever.
So time out, Dave, time out. Last show, Harry was calling a top of 4,700 on the S&P this year. So you want to revise that? You want to revise that, Harry? Are we going in a different direction now?
I think we could top, yes. I think we could top more at like 4,500 and between now and late July. I would say late July at 4,500 would be my best forecast. In the short term, you're always looking at scenarios and you can't predict the news and you know, that sort of stuff. But that's what I'd say, that a little lower, 4,500 and maybe as soon as late July.
So if you're going to stay in growth, then essentially what you have to do is have one finger on the trigger, ready to pull that trigger when you see the momentum start to turn, right?
Well, yeah, and you can do two things. I got this channel. The easiest sell signal is if it breaks that channel around 4,100 ahead on the S&P 500, you sell there. But the better play is if we just get to the top of this channel one more time and what I call a fifth wave, I would tend to be selling at the top of the channel, or you could do both, sell at the top and then again at the bottom. But yes, you can't let this go too far. The most unique thing, I have tracked all the major bubbles in the last century and around the world, okay? The first crash of a bubble of this magnitude tends to be 45 to 50% in 2 to 3 months. And I have a megaphone pattern with higher highs and lower lows that more accurately projects about a 50% decline in stocks. Let's say you peak in late July. By September, October, we could be down 50%. This is not something to sit through in value stocks.
I know. And I know ultimately, last time we spoke, you even said perhaps as low as 1,500 ultimately on the S&P, which brings us back 21 years. So, Harry, unfortunately, we need to leave it.
Let me be clear. This is the first crash. The overall crash is likely to be, yes, down to 1,500 or lower over a couple of years.
Yeah. So, Harry, we need to leave it there for now. I hate to cut you off because you always have so many great things to say, but thanks so much for joining us. We appreciate it. Sure. And coming up, we'll talk about the next retirement planning mistake that you might just be making right now. And you heard Harry allude to it a little bit, having the wrong bond strategy. Plus, we'll talk to income specialist Tim Sparks in Kentucky. All that and lots more coming up right here on the Income Generation.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Welcome back to the Income Generation. I'm David Scranton, and thanks for tuning in as we take a look at the 4 mistakes that you might just be making with your retirement plan. Now, so far, we've covered the importance of risk tolerance, as well as the difference between having the wrong versus the right stock strategy. But now it's time to talk about a mistake that you might just be making with your bond strategy. And to put it simply, the mistake could be not having a bond strategy, because if that's the case, there are generally two reasons for it. First, you're putting too much stock, so to speak, in the media, in the words of media bond bashers. And of course, this is an old story when it comes to the financial media. Whenever interest rates are low, the bond bashers start bashing, based upon the simple rule that when interest rates rise, bond prices fall. So when interest rates have no place to go but up, it's easy to cast bonds as a bad investment. And of course, the bond bashers have been especially loud recently because interest rates have, in fact, risen since the start of the year. From January to April, this did create a headwind for bond investors, and also created a good opportunity for the bond bashers to say, "I told you so." However, none of this is nearly as simple as they'd like you to believe. For one thing, interest rates aren't the only thing that affect bond values. And I've explained before how something called credit spread compression, which also occurs when interest rates rise, creates a natural softener that limits losses for many bond investors. But even more important is that when you're investing in individual bonds, any loss that becomes due to this rising interest rate environment is only a paper loss. Why? Because you typically have a contract protecting the full face value of your bond if you hold it to maturity, assuming, of course, there have been no defaults. And in the meantime, your income return is also unaffected, which in many ways is really the most important point when you're retired or close to retirement. Now, the other reason you might be making the mistake of not having a bond strategy is because you're not actually invested in bonds, but instead in bond funds. Something we'll be talking about more when Jeff joins us in just a moment. But now let's get to another one of your questions. Sam from the great state of Missouri, I believe is how they pronounce it if you're from Missouri, says, "The scary thing for me about bonds is that they seem to be such a long-term commitment. Even a 10-year bond, let alone a 30-year bond. So how can I get over that fear?" Well, Sam, you can always sell things early. There's no law that says you have to hold it to maturity. And if you think about it, you may have a stock which is totally liquid or a mutual fund which is totally liquid, but if the market drops, you might be selling it with a 50% loss if you need your money, a 50% penalty. Well, if interest rates go up, you'd be hard pressed to find any bond that's going to be down 50% in value. The only way that might happen is if there were a corporate bankruptcy pending, right? So the reality of it is the time frame commitment is actually your friend, because it's the thing that helps you minimize your potential losses and at least gives you a choice to eliminate the losses altogether if you hold it to maturity. So Sam, thanks so much for writing in. We really appreciate it. And be sure to send me your retirement questions by emailing me at askdave@theretirementincomestore.com. Jeff, credit spread compression, not a simple topic, right?
Wow. So you know what causes credit spread compression, Dave, is the demand for fixed income has never been higher. Everybody is searching for yield. Everyone's looking for a rate of interest via dividends or bond and bond-like instruments. And that's just the reality that we're in. And the reason they're doing that today is because the market is at an all-time peak. We're at a tipping point in stock market values. And so people want to gravitate towards getting a decent rate of interest on their money compared to betting solely on the markets.
Yeah, and credit spread compression is simply created by optimism. So when the interest rates came up from the first part of the year, where the yield on the 10-year government bond almost doubled, that's because we're optimistic that the economy is growing, getting back on track. And that optimism caused stocks to go up, but it also causes credit spread compression to compress, which is simply defined as the extra interest that investor needs to earn to justify going from what theoretically is a risk-free government bond to a corporate bond of a particular grade that has some risk. When things are going well and investors are optimistic, they need a little less interest, a little less additional interest. When they're pessimistic, they need a little bit more. So what that basically means is even though the yield on the 10-year government bond has doubled, the yield on most corporate bonds hasn't doubled. In fact, it's probably only gone up a little bit, which means those prices have come down just a little bit. So Jeff, now it's time to bring in our next guest, and we'll ask him a little bit about the difference between bonds and bond funds and that second problem, and that's Tim Sparks, founder and president of Sparks Financial Group, a retirement income store located in Lexington, Kentucky. Tim, thanks so much for being back with us on the Income Generation.
Thanks for having me.
Tim, it's great to see you all the way from Kentucky today. I've got a question for you, though. We're talking about here with inflation. And so the demand for fixed income, interest earnings, yields, and dividends has never been stronger. Are you finding that in Kentucky as well?
Oh, yeah. Yeah, a lot of people are looking for ways to, and, you know, of course, the way we market to the people here locally on the radio and stuff is investing for income, or what we call the burden of hand, where they can get, you know, a reasonable 4% or slightly more net to them each and every year, which, by the way, does keep up with inflation. They can do that with a balanced approach, so to speak, and they can have a mixture of, you know, stocks and bond-like instruments to do that.
And so what type of bond and bond-like instruments? Are we talking about corporates? Are we talking about ETFs, or a combination?
A combination, because, you know, depends on the, you know, the amount that's going to be invested in the, you know, more of the fixed instruments. They, you know, if it's less than maybe a certain amount, then maybe they want to be more diversified, more of an ETF portfolio that generates what we see maybe 3 times more in income than what they're in their current bond portfolios.
So in general, then, customers are telling you today that they're more concerned about income than they are about having money in stocks, especially for the ones that want to retire, correct?
Yes, correct.
So Tim, tell us, you know, if somebody has over $250,000, why should they go more toward individual bonds instead of bond mutual funds?
Well, there's 2 guarantees with a bond that a bond fund doesn't carry. And of course, it's depends on the default, but you know, bonds are generally going to pay, you know, 3, maybe 4% at best in our current portfolios, and they're pretty much going to receive that. That's a return on their principal, but at the same time, for the maturity period, whatever that period may be, 5 to 10 years, they get their principal back. Or bond funds, they do not get that.
Yeah, and once again, they have, at least the individual bonds also have a fixed income, which is in many ways the most important thing. And what other types of things do you like to sprinkle into these income-based portfolios? You know, we talk about bonds and bond-like instruments. So let's just cover some of those bond-like instruments for a moment, if we can.
Well, they can be, depending on the amount of, you know, risk they want to take from the stock side. It can be dividend paying stocks, maybe paying 3.5 or 4% at best today, which is still an increase from what they're getting in their current funds or ETF portfolios, I see. But at the same time, we can actually, on the bond-like side, have you know, more of a preferred stock, or, you know, BDC, or even real estate.
Great, yeah, and those are things that are riskier on a standalone basis, but you know, sometimes the way it works with investments is you add a little bit of a riskier thing and you can actually lower the overall risk of the portfolio. Real quick, when and where can folks in your area listen to your radio show?
They listen to it on Saturdays at noon and on Sundays at 10 o'clock in the morning.
What station?
590 Talk AM.
I love it. Tim, thanks so much for being back with us here. We really appreciate it.
All right, thank you.
And coming up, we'll talk about the 4th mistake that you might just be making right now. And we're also going to welcome our next guest, income specialist, Brad Williams. All that and much more right here on the Income Generation. I'm David Scranton. When it came time for my mom to retire, one simple mistake forced her to work years longer than she should have. And that's why I started the Retirement Income Store, to help hardworking Americans 55 and over plan for the retirement they deserve. I couldn't help my mom, but maybe I can help you.
If you're 55 or older, please claim our free Retirement Income Kit. Chock full of information you need to know to get steady income during your retirement. Call 866-314-7227. Online at theretirementinComestore.com.
Welcome back to the Income Generation. I'm glad you're with us. I'm David Scranton. Today we're talking about the 4 retirement planning mistakes that you might just be making. And so far we've covered the importance of risk tolerance, making sure you have the right stock strategy, and also making sure you have the right bond strategy. But now it's time to really discuss the 4th mistake, having the wrong retirement income timeline. So if you've identified your retirement goals, then you probably know when you'd like to retire, and that's good. But it's just as important to know when the time is right to switch your financial strategy from growth to income. And here's an example that I've shared before. Let's say you plan to retire in 5 years. However, your plan is to invest primarily for growth, hoping you get 8% total return or so over a 5-year period. But only 1.5% of that, let's say, comes from dividend income. This would be as if you're in the S&P 500, right? Then right after retirement, you'll start switching over and you'll invest for 4% income. That's how a lot of people think it's done. Snap your fingers, make the switch. But here's the problem. You might get that 8% growth, but you might not. And even worse, the market could drop by 50% or more and take many years to recover, 6 or 7 years. That's happened really twice from 2000 to 2013. And with so much uncertainty in today's market, it's possible that we repeat another period like that 2000 to 2013 period. But let's say your plan did work and you got that 8% total return. And let's say you started with $1 million. Here's how the math would work out. You'd end up getting about $58,000 a year, starting 5 years later, once you converted to something that paid that 4% income stream, that 4% interest or dividend. In other words, the $1 million at 8% total return for 5 years leads to that $58,000 of income. But now let's say the worst happens and the market took that major drop. You'd probably no longer want to switch to income after retirement because you'd want to try to recover your losses, right? And in that case, you could count on getting just $16,000 of annual income instead of $58,000. Why? Well, that calculation is based upon your 1.5% dividend yield because that's really the only known factor in your plan. So $1 million at 1.5% dividend over 5 years, yes, leads to only $16,000 of income. So now, what about instead of waiting? What about changing your timeline and start to investing for 4% income today? Well, in that case, the math goes more like this. $1 million at 4% interest/dividends for 5 years leads to $48,000 of annual income. So in other words, instead of gambling between $16,000 and $58,000, you have a more assured $48,000 a year. So with that plan, you'd actually start getting your income now, which makes it even better, regardless of what the market does. Now it's time to take one more question from you. Gordon from Georgia says, are there any income-based investments that you generally don't like or that you wouldn't recommend? Depending upon the timing, yes, there are things that don't make sense. I mean, right now, buying a government bond doesn't make a ton of sense because you're only going to get 1.5% if you buy a 10-year government bond, and most people can't retire on that low of an interest payment. Something I generally am not a big fan of is MLPs, Master Limited Partnerships. Some things changed a few years ago with taxes that make them really less attractive, and frankly, they're one of the higher risk income investments. Some consider them to be a bond-like investment, and I get that, but they tend to be a little bit more dangerous. And for the other things that we talk about in the show all the time, it really becomes a question of timing. So Gordon, thanks so much for the question. Great question. And once again, be sure to send me your retirement questions by emailing me at askdave@theretirementIncomestore.com. Now, Jeff, I know you have some words of wisdom, I'm sure, to put a bow on this show when it comes to investing for income.
Yeah, Dave, it's time to bring in the excitement. So let's create some income for people in their 60s. How do you do that? You have to transition from a growth mindset or accumulation while you're working and saving money to now we've got to create income and preserve the asset. And that's the transition pretty much everybody has to make once they retire and leave the private sector, Dave.
And that's usually what, about 10 years before retirement, you want to start making that. So for some people, it might even be in their 50s. A lot of people, it's probably in their 50s. And of course, that's because we had that period for 2000, 2013, the market was underwater for 13 years. So 10 years is probably, truly a better start. But I also want to say this, it's not too late. If you are retired now and you're concerned about this and you haven't made the transition yet, the good news is the market's high now. It's at a record high. So you're lucky. It's not too late to make that transition from the G to the I, from growth to income, even if you are currently retired. And now I'd like to bring in our final guest of the show, who I'm sure has a lot to say about this, and that's Brad Williams, founder and CEO of Brad Williams Financial Services, a retirement income store in Huntsville, Alabama. Brad, it's great to have you here with us.
Dave, it's great to be here with you and Jeff. I appreciate the opportunity to talk.
It's great to see you, Brad. We're talking about mistakes people make in retirement today. We know the number one mistake a retiree can go through is volatility. So do you find that your people you speak with before they become your customers don't have a good understanding of volatility?
Well, they don't, Jeff. And one reason is that most of them have accumulated in their 401k and they're only used to mutual funds. And that's the only game they think in town. In fact, a lot of them don't even, when you say something about equities or stocks, they say, no, I have mutual funds. You got to teach them that actually you do have stocks. They're just in mutual funds. So they really don't know there's other options out there until we talk.
So really, they don't even understand what the most common or the number one mistake could be. So give us an idea of what you think the top 1, 2, or 3 mistakes our retirees need to avoid when it comes to their money.
Well, again, to echo what you were saying before, is making that transition from the accumulation stage of life to the distribution stage, and then that middle ground of preservation where they're shifting from the growth aspect of their investments to the income. And that's the key that a lot of them don't really think about, is that they're not going to be able to get consistent income from growth, that it's going to have to come from income. And the problem is most of them don't know the tools that are available.
Sure, because if you can't eat growth, because if the market's not growing, you end up eating your own principal value, and that's the opposite of what we want in retirement. And when you say that to, or you show somebody that example, they really kind of get shocked because they say to you, hey, Brad, I didn't really want my retirement to work out like this, correct?
That's right, yeah. And the old analogy of, what do you want, the chicken or the egg? Because the egg keeps coming. Once you eat the chicken, it's gone.
Yeah, good. Yeah.
That's a good one, Dave. That's a real good one, Brad.
So you mentioned the 401k before, and I know you always call this having 401k brain when you're invested for growth. That's all you've done in the 401k. And most people think, gee, if I'm not retired, my money is stuck with this limited number of mutual fund options that are in the 401k. But that's not necessarily true if they're over the age of 50, 55, or 59 and a half, depending upon the plan, correct? That's
correct. Yeah, and a lot of them are relieved when they find out that there are other options.
Yeah, and another mistake is, and this is called an in-service, as you know, an in-service rollover. You can roll it over to another account in service, even though you're still working, keep contributing to the 401k, but roll a bunch of it over. But another fallacy I hear a lot of times is people say, well, I can't take it out of the 401k, it's going to be taxable. But if you do this in-service rollover, it's not taxable. It doesn't cost them anything, correct?
Yeah, that's correct. And the way I usually put it to them, I said, we can move this from your 401k to an individual IRA to give you choice, and it does not create a taxable event.
Now, you don't want to have them receive the check, right? Because then there's going to be a mandatory 20% withholding. In which case, the only option is to go direct to whatever IRA custodian they've already set up. And that's the only way they can be assured that it's a tax-free transfer, and now they can have better income-generating options, right?
That's correct. And usually I handhold them through the process by calling their provider, their 401k, with them in the room and going over the options so that they feel comfortable that we've made the right options, instead of, giving that as a homework assignment.
That's right. It's easy to mess it up if you do it yourself. So that's what I love about you. You're always so dedicated, Brad, to your clientele and what you do, a true professional. Thanks for being back with us on the show. We appreciate it.
Oh, thank you. It's always a pleasure.
And thanks to Jeff and all of our guests today. We've had a great time. Here's the bottom line. If you're close to or in retirement, and you're concerned about your money, it's essential you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.